Welcome to the Fear and Greed Daily Business Interview. The local equity market hasn't had a great time of it recently. The market a week ago hit a technical correction, down 10% from its peak, with interest rates, geopolitical uncertainty, the global outlook, including oil prices and other factors weighing on the bourse. So where to from here? How should investors think about the market, particularly large caps? I welcome this morning Matthew Haupt, Lead Portfolio Manager of WAM Leaders. Matthew, welcome back to Fear and Greed.
Thank you for having me. Great to be here.
So WAM Leaders invest in large caps. What is it that you're looking for?
Stocks that go up in value, ideally. But yeah, what are we looking for? Generally, we look across the market and we're just trying to identify, companies that are obviously valued correctly or cheaply, and then having a range of factors which will drive the share price up, whether they be macro tailwinds or company-specific catalysts. But just trying to identify a reason why that stock will go up in value and why the market will look at it differently and apply a different valuation at a point in time. So, that's the key thing with stocks, is trying to identify the reason why the market is valuing it as it is, and then finding the reason why it will change that way it looks at a company. So, that's the key thing with investing, is trying to find that at all times.
Okay, so is there a sort of a process here whereby you look at the top 50 or whatever WAM Leaders is in, and kind of obviously there's going to be a quantitative aspect to it, but then the qualitative aspect, how do you do that part of it?
Yeah, qualitative is, that the thing you can't really see as such. So for us, it's really around the quality of management. That is crucial, as we all know in our own lives and businesses. Management is crucial, as they set the tone and set the environment for the workforce to prosper. So ideally, on the qualitative front, is meeting with management, spending as much time as we can, and channel checking previous employees just to see, have they got a track record in success? Because as you know, the top 50 is pretty competitive. The growth rates are not outstanding. So management is crucial. So that's what we're trying to identify, and also the depth of management too. So quite often the CEO, CFO gets all the headlines, but we're really looking at the bench strength and, possible successes below as well. So it's really just face time with management and channel checking that they actually have the credentials to outperform. That's the real key for us.
Okay, and just before we kind of leave this kind of line of chatting, what about dividends? How important are they in your process?
Dividends aren't really, solely a focus for us. I guess, the second derivative is high dividend payers generally have good quality businesses. So, dividends isn't the focus, but high dividend paying company is generally a high quality company. So I guess, peeling it back a bit, it's more that second derivative part. Is the company high quality? Does it have good cash flow? All those key things, rather than dividends specifically. So it's more an outcome of, the positive business.
Okay, so let's look at where we are now. Is it a good time to be in large caps, to be thinking about investing in large caps as opposed to mid caps or small caps, for example?
Yeah, it's an interesting question. Can you time the market between, sectors? Is there a big enough valuation discount between sectors, and why is there a discount? Obviously, small to mid caps are, historically look pretty cheap, but you really got to peel back the reasons why that's the case. And the index doesn't really capture what's underneath the hood. So to look at index levels solely is missing the point, I think. You really got to look at what is moving those indices. And for us, that's the more important thing, rather than, size of company. I think the main factors are around what environment are they going into? Is it beneficial? Do they have company-specific reasons why they should go up or down, rather than just looking at a size metric and thinking, invest in small caps because it looks like it's a cheap place to invest? It sort of rather than being simplistic, I think you really, to do your homework, you really got to go underneath the hood of what's happening in the economy, in the business cycle, and the macroeconomic cycle, instead of making general call around the size of a company being a driver of where to invest.
Stay with me, Matthew. We'll be back in a minute. My guest today is Matthew Haupt, Lead Portfolio Manager of WAM Leaders. Okay, so if we look at some stocks now, let's take the banks on the basis of what you've just said. Is there one of the big four, for example, that you think will outperform the others at the moment?
Generally, the way we look at banks is which ones are crowded going into results, because they're so well analysed, and we get monthly data around market shares and the like. So you really got to look at positioning. And at the moment, National Australia Bank and ANZ I would class as crowded trades in the banks, and Westpac and CBA are not crowded. So on that basis, you'd say the ones which look the best, and we're always got a contrarian bias, would be Westpac and CBA. We'd think they would trade better. Westpac, I think, kick it off. They're the first report. So again, what we would do here is we'll see how the first bank report and then adjust our weightings based off on how that first bank reports too, because they'll give you an indication of how the market is thinking about the results. But overall, the environment is incredibly competitive. The mortgage wars have been ongoing, and the deposit wars. So overall, I think the sectors will perform broadly in line. I can't see a reason for the sector to outperform wildly from here. So I think it'll be a real litmus test, that first result, to see more so on positioning of how people are positioning banks. I think at the moment, the last time I checked, it's around a slight underweight, the Australian banks. They were a large underweight, but that has closed recently. So be very interesting to see how that goes. But generally, you trade around which one is crowded and the under-owned banks. So that's how we look at it.
Okay, so what about some of the stocks you do like or don't like? I mean, we can go through the sectors, but rather than do that, let's jump to some of the ones you like.
Yeah, so it's a really interesting market environment too, because the divergence between stocks is huge at the moment. You've got stocks near their 52-week highs, maybe after the correction we've had just recently, they've come off a bit. And then on the other end of the spectrum, you've got stocks near GFC lows, around 2016 levels. A lot of stocks are hovering around that level too. So there's a real divergence. So again, we've got that contrarian pick in our nature. So we like a lot of the names that are trading heavily discounted to historical valuations. So a few of them, a most recent one, really like the business Aurora. They been the spin out of Amcor. They had a recent acquisition, which the market is very skeptical on, the Saverglass acquisition. The market is skeptical because of the size and where it came from and the location. And we think those fears are well overplayed. So Aurora looks like a really good investment for us at this point in time. Again, the acquisition, they'll get it in the new year. It's a higher margin business than in their existing business. And the pro forma numbers put out by Aurora, we think they're very safe. So we think the market has got that wrong at this point in time. And then if we look at another one, we think Treasury Wine looks pretty good too. And again, it's an acquisition they've just in the process of raising money for now. We think that company is well placed. Predominantly, premium luxury end of wine has been doing okay in a pretty challenging environment as we go through a destocking phase and a lower demand period after the surge through post-COVID. So we think that looks good. It's got China to come back, we think, in the second half of the financial year. And then the acquisition they're in the process of doing now, which is a US business, again, we think that brand has potential to be rolled out internationally. So, you've got a few key drivers here of potential earnings growth, even in the form of the underlying business with the China coming back. And then if you layer on top of that the acquisition, it actually looks like, it's going to have quite strong growth over the next 3 to 5 years. So that's a company we're quite excited about at the moment as well.
Okay, what about the market generally over the next year or two? How do you think it'll perform?
I think the time horizon the market has at the moment is about 1 month at a time, maybe
Right.
1 week. But like we think the direction we're going in, the ultimate place we're going to is an interest rate cutting environment. So we think that happens around the middle of next year. So in that environment, you have to be positive equities. It's that journey getting there that we're a little bit uncertain on. So the journey, it started, the high for longer was kicked off in September, and then I think the financial condition tightening scared a lot of we'll talk about America, the Fed members. So they walked that back. And even the other day, with the Fed were trying to walk back the message they created in September, the high for longer, which really contracted or tightened financial conditions. So it's a real fine line. They have to keep financial conditions tight to squash that last bit of inflation, and they cannot let the forward market or the forward curve start pricing in aggressive cuts, because that will undo a lot of the work they're trying to do. So it's really a game they have to play now, where they actually don't really believe what they're saying. They can see the slowdown happen, but they cannot take their foot off, and they have to remain tight until it all comes crashing down, basically. So that's the environment we think we're in over the next period. So it's going to be pretty volatile as they have to keep things tight despite a slowing economy.
Matthew, thank you for talking to Fear and Greed.
No, thank you.
That was Matthew Haupt, Lead Portfolio Manager of WAM Leaders. Remember, this is not an investment podcast, so you should always seek advice that suits your circumstances before making investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Aylmer. Enjoy your day.